what's happening to the markets in India today, where are they expected to go? I know neither you nor I would like to answer this question. I'm asking this question on behalf of millions of investors.
So our markets have witnessed Triveni Sangam of fundamentals, flows and sentiment together, which is why it is one of the best performing market. Between 2010 to 2020, corporate India's profit growth moved from 3 lakh crore to 4 lakh crore. Over 10 years, 33% growth, less than savings bank account. No wonder markets didn't go anywhere and the return was mid-single digit. From 2020 to 2024, profit multiplied almost 4 times, from 4 lakh crore to 15 lakh crore. Undoubtedly, on that strong fundamental, market cap also went up. On top of it, now our market is driven by domestic liquidity. In the same time period, domestics are owning almost 10% more than what foreigners are owning. And sentiment towards India by and large has been positive. So our markets have witnessed one of the most broad-based rally backed by fundamentals. Earlier we have seen rally which were driven more by liquidity or by sentiment, but not necessarily backed by fundamentals. Now at this point of time, we are one of the most expensive market in the world. Yes, fundamentals, liquidity and sentiment justify those valuation. But then you are now like Rohit Sharma or Virat Kohli. When you go out to bet, people expect you to hit 4s and 6. People expect you to score a century. We carry the burden of expectations. If we meet those expectations, returns will continue to come. But if you disappoint, then there will be a correction. My feeling is that for an investor, if they moderate their return expectation, what you saw in last 5 years was about 21% return. That's not going to happen in next 5 years. You have to moderate your return expectations significantly. You will still make real return. You will still make better return than most other instruments.
In terms of valuation, there is generally among wise people that there is a revert to mean. So our general PE ratio, which is price earnings multiple, has been in the range of about 14, 18. Sometimes even 18 is considered expensive.
Yeah.
Today we are standing at 24. Now, do you see corporate earnings justify a 24? I'm talking about the market, the Sensex PE. Do you see corporate earnings growth justify such a high PE?
So Gautam, one thing is the change in composition of Sensex or Nifty. By and large, B2B businesses having lower valuation have moved out. And B2C companies with higher valuations have entered. Titan, Trent and so on and so forth. Second, government companies by and large have gone out and private companies have entered. You adjust for this, then our P ratio is reasonable. It's not cheap, it's not very expensive, it's reasonable. Are there sectors where P ratio looks high on the much higher side? Of course, capital goods, infrastructure, real estate, defense stocks, low floating stock counters, their valuations are looking on very, very higher side. But there are many sectors in banks, telecom, FMCG, IT, pharma, auto, cement, where you still have fairly valued stocks provided your return expectations are moderate. If you are expecting last 5-year kind of return, then these are not the valuations where you can enter.
So what sort of returns should people expect from the index? Not everybody is a stock investor or has the capability to buy and sell stocks the way you do. But through you, as funds or as an index, I think index is the best benchmark.
Yeah.
What are we looking, what kind of returns should an Indian investor expect?
So my thumb rule is that if our inflation is going to be in the range of 4 to 5%, equity market is unlikely to deliver more than high single digit or low double digit return. Now we are coming at a very, very fair valuation. So between high single digit to low double digit, that's the kind of return possible on a sustainable basis.
So let's say 12%.
Whether it's 8, 9, 10, 11, 12, it all depends upon from what point to point we measure.
So this high growth that you're talking about, I'm not even talking about 10.5. Even if we continue with 8.5, the general sense is GDP growth plus inflation plus risk premium. That takes it into 15 to 17% expectations. Why are you limiting it to 8 to 12?
So, one, as a fund manager, we have always seen under promise and over deliver. Number two, we are entering at valuations which are reasonably pricing in all this scenario. Had the valuation 20% cheaper, your returns would have been 20% higher. But we are entering at a stage where a lot of the good news is already into the prices.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.